Have you ever listened to people talk about investing and felt like you'd stumbled into a zoo? You hear about bulls charging and bears hibernating, but what does any of that actually mean for your money? Well, let's dive in and decode the financial world's most famous animals. And that's a really good question, right? Because all this jargon can feel kind of confusing, especially if you're just starting out. But these aren't just quirky nicknames. They actually describe powerful market trends that have a huge impact on pretty much everyone's investments. So here's the game plan for this explainer. We're going to untangle the metaphor, define what these animals really mean, look at the psychology that drives it all, check out some history, and then most importantly, cover some strategies for every market season before we talk about the long game.
Okay, let's start right there. These terms might sound a little weird, but they're really just a shorthand, a way to describe the overall direction and, the mood of the market. And understanding that mood, that's the very first step to making smarter decisions with your money.
All right, let's get right to the definitions. We're going to make this super simple and clear, and we'll start with the more optimistic of the two animals.
A bull market. This is when things are generally on the up and up. Prices are rising, people are feeling good about the economy. And the name? It's thought to come from the way a bull attacks, by thrusting its horns upward. A perfect symbol for a rising market, right?
And there's actually a common rule of thumb for this. While, general optimism is a big part of it, the pros officially call it a bull market when a broad market index, think of something like the S&P 500, climbs by 20% or more from its most recent low. That 20% signals that this isn't just a good week, it's a sustained period of growth.
Now, on the flip side, we've got the bear market. This is when prices are falling, and that optimism we just talked about, it turns into pessimism. And the name, you can probably guess, comes from the way a bear attacks. It swipes its massive claws downward. A pretty fitting metaphor for a market in decline.
And yep, just like with bulls, there's a magic number here too. A market officially enters bear territory when it drops 20% or more from its recent high. That 20% number is the key. It means we're looking at a significant, sustained downturn, not just a couple of bad days.
Okay, so this is where it gets really interesting, because markets aren't just about numbers on a screen. They're driven by people, by human emotion. Confidence, fear, greed, you name it. And it's this psychology that really turns a simple trend into a powerful, self-reinforcing cycle.
This table lays it out perfectly. In a bull market, you tend to see a strong, growing economy with low unemployment. That makes investors feel confident, optimistic, and eager to buy, which pushes prices up. In a bear market, the story flips. The economy is often weaker, maybe unemployment is rising, and that confidence turns to worry, which makes people rush to sell.
And all that psychology has a huge, real-world effect on basic supply and demand. During a bull run, everybody wants in. The demand for stocks is sky high, but not many people want to sell their rising assets. That just pushes prices even higher. In a bear market, it's the exact opposite. Fear takes over. Everyone wants to sell, but there are very few buyers, and so prices fall.
Now, it's really easy to get caught up in the headlines of the day and feel like whatever's happening is the end of the world. But it's so important to remember these cycles are a totally normal part of market history. They've happened before, and guess what? They're gonna happen again.
I mean, just look at the last couple of decades. We had a brutal bear market back in 2000 when the dot-com bubble popped. Then another massive one in 2008 with the financial crisis. But what came after that? One of the longest bull markets in history. And then, of course, the sharp, sudden bear market in early 2020. The pattern is crystal clear. Downturns happen, but so do recoveries.
So knowing all this, how are you supposed to act? What do you actually do? Well, the key isn't trying to perfectly predict these cycles, because let's be honest, that's pretty much impossible. The key is having a solid strategy that works no matter what the market season is. During a bull market, the biggest danger is getting swept up in the hype. You have to fight that FOMO, that fear of missing out, that makes you want to jump into stocks just because everyone else is. The smart move is to stay disciplined, set realistic goals for taking profits, and keep an eye on your portfolio.
And in a bear market, the number one rule is just don't panic. Seriously. Panic selling when prices are low is probably the single biggest mistake an investor can make. Instead, try to flip your thinking. A bear market is basically a big sale on great companies. This is where a strategy like dollar-cost averaging, which just means investing a set amount of money regularly, becomes a superpower because you automatically buy more shares when they're cheap.
And that really brings us to the core idea here. True success in investing isn't about some secret trick or timing the market perfectly. It's about being patient, being disciplined and having a long-term plan that you actually stick with through the good times and the bad.
So let's wrap all this up by focusing on that long-term perspective. Because if you only pay attention to today's scary headlines or tomorrow's hot stock tip, you are absolutely missing the bigger picture.
And check this out. This data tells a really powerful story. Since 1942, the average bull market has lasted over 4 years, and the average bear market, less than a year. This shows you exactly why patience pays off. Historically, the good times, the periods of growth, have been much longer and stronger than the downturns.
So look, if you remember just one thing from all of this, please let it be this. Markets move in cycles. The ups and the downs aren't a sign that the system is broken. They are a normal, natural, and expected part of how the whole thing works. In the end, the bulls and the bears are always going to be there, battling it out. You can't control them, but what you can control is your own plan, your own strategy. So the real question isn't about which animal is going to win tomorrow, it's about whether you're ready for both.